The reason why we're covering what we're covering today is we think these are the key themes that are driving markets, and this is where individual stock prices will take their lead from over the next 12 months. So we figured that we will cover them. Given that we're coming up to June 30 as well, which is a very, very busy time in markets with tax selling, we think it is imperative that investors have the knowledge of what's going on abroad and what's going on here, thus what we're covering today.
Fantastic. So, Nick, let's move ahead to topic number one, US interest rates. No surprises today, Nick, with interest rates in the US left on hold. It seemed to be the general expectation out there amongst fund managers and most investors. What do market matters anticipate will happen with rates in the US moving forward? And what are some of the catalysts behind those expectations?
Okay. Well, firstly, let's look back at what's happened to date. We saw an interest rate hike at the end of 2015, a 25 basis point hike. And at the time, that set the tone or laid the platform for what was going to be quarterly rate hikes of 25 basis points this year. Now, we haven't seen that. We've seen a very interesting start to the year. Now, the meeting last night with the Fed was a little bit more dovish or pessimistic than most thought. And what has now happened is the probability of a rate hike has actually dropped to 24% in September, and a full hike is not priced in till December 2017. Now, what this means is markets are now pricing in lower rates for longer, which will support asset prices generally, which means for us, the recent weakness in markets is a buy. But it's obviously not as simple as just throwing a blanket over the market. Now, in terms of hikes, we do think there'll be at least one to finish the year, maybe two. But it is all contingent on the data flow. Now, where we're really looking for the data flow at the moment is the labour market, and the key theme here is wages growth. Now, if we see wages growth increasing, we will see a tightening labour market. Obviously, unemployment as a result goes down, which leads to the prospects, which it fundamentally leads to inflation, which then feeds into earnings increasing, wages growing, which is actually naturally a healthy thing, which would allow the Fed to push rates up. Now, let's look back at last week. We saw a bit of a negative data print. The non-farm payrolls wasn't great, and as a result, people are now factoring in the likelihood of a hike being further down the track. Now, we think that potentially could be a bit of an anomaly, and we're looking forward to the next data print, which is coming next month.
Okay, very interesting. So, moving away from that 3 or 4 hikes that were expected earlier this year, only expecting 1 or 2. Now, what implications will another interest rate hike or maybe 2 interest rate hikes have on our markets over here in Australia, Nick?
Okay, so the best way to encapsulate this, we thought, would be to look at a couple of stocks in particular. Firstly, I'd start by saying what higher rates mean is it means that the US dollar will be stronger. Also, as well, the cost of capital increases, and a lot of stocks that carry a lot of stocks that carry debt, will obviously not perform as well. Now, what we've got here, this is a chart that I referred to before. I was talking about wages growth. I touched on that before. The trend is slowly increasing. But if we go to the next slide, first of all, the stock that we've got here is Sydney Airport. Now, this stock has been bid up and bid up almost because people are flocking to safety. Now, this stock, in our opinion, is trading at a scary multiple. And here at Market Matters, we don't own it, but if we did, we'd be looking at probably taking profits here. We think sometime over the next 12 to 24 months, we could easily see it drop $1. Now, the yield on it has got to a point where it's only, a little bit over 4%. It's heavily indebted, and if interest rates do go up, all of a sudden their debt becomes more costly to finance. So this for us is just an area that we're highlighting. We're not saying rush out and sell it today, but towards the end of last year or last year, we were anticipating a big correction in the banks because that trade just seemed too easy. Now, we think the infrastructure space is looking a little bit like that. So, we call this a warning sign. Don't throw the baby out with the bathwater, but it's definitely a warning sign. Now,
well, next chart. On that note, Nick, what other? Here's another one, Transurban Group. It seems to, I guess, another stock that's an infrastructure-based stock that's thrived in this low interest rate environment. We know a lot of people are holding on to this one. How's Market Matters viewing this particular story?
Okay, this is another one that's pretty similar to Sydney Airports, which I just touched on before. Now, probably the best term to encapsulate this is this stock is arrogantly long, and we think this is very dangerous. And this chart looks like it could easily consolidate. We think that you will get an opportunity to buy this stock closer to 11, even under 10, sometime in the not too distant future. For that very reason, we wouldn't be chasing it, and we'd be definitely taking some profits up here.
Okay, fantastic. Now, moving forward, Nick, I guess to one of the most topical stories in the market over the last week or two, the Brexit, which of course is Great Britain's potential exit from the European Union. Nick, could you shed some light on what that really means, what Market Matters is expecting on that front, and the implications, I guess, of an exit?
Well, Ed, firstly, I'd start by saying the implications of a Brexit are incredibly scary for markets. Now, I don't think anyone really knows what the implications would be if Britain did leave the EU. All I could say is there would be quite a substantial fallout from it. Now, let's look back at some events that we've seen in markets in the past. That initially we saw that Greece was potentially going to leave the EU. No one really cared too much because Greece was quite small. Now, something like the UK is obviously a different kettle of fish. Now, what we are looking at here is the probability. We look a lot at probabilities here. Now, not all that long ago, the probability of a Brexit was 20%. That number has now gone to about 40% recently. Now, we think leading closer to the vote, which is on the 23rd of June, put that one in your calendar, investors, we think the probability of a yes vote will shrink closer to the date because of uncertainty and fear driving investors. As a result, we do not think that it will happen. However, you've got to be prepared for both scenarios. So I guess at the moment, we're looking at a few things very closely, which the next slides will show.
Well, Nick, having a look at these slides, I guess one question is, okay, so you don't think there will be an exit, but do you feel that there might be, I guess, negative sentiment towards the whole scenario? And if so, how are you managing that?
Yeah, Ed, we think it's all about risk. And as a result, leading closer to that, people tend to de-risk. And even if we don't see it, you will see stocks rebound. But they will probably be sold off in the lead up when there's uncertainty, especially if the probability is even up. Now, the first chart we've got here is Clydesdale. Now, this is a stock that we're not necessarily that interested in. Just to refresh investors on what this is, this was part of NAB, and this was IPO'd recently. Now, they've got 100% exposure to the UK. Obviously, they're based in the UK. Their stock price performance has actually held up okay recently. We're not necessarily looking there, but all we want to emphasize is, look, if you look at the price action here, they got up towards $6 and they've now come back to about $5.26. I guess if investors are bullish on this story, which we don't necessarily have much of a firm view, it is something that could be looked at leading into a Brexit, because it is being sold off on fear around it.
Okay, fantastic. I guess another one, we've got Amcor here. They've got earnings which are exposed, I guess, to any volatility in this Brexit. One that Market Matters has, I guess, invested in the past. It's done well. It's had a tremendous run, really flirting with that $17 mark and had a bit of a pullback. How are you seeing Amcor and how's Market Matters playing it?
Okay, so Amcor is one that we have been bullish on in the past, and we have called it higher in the past. Now, we did call it a sell above 15. Now, it got a lot higher than that, but it has since come back below that $15 level. Now, they do have some earnings exposed to the UK, Now, what our current opinion on this stock is, we think it is relatively unclear, but technically if we were to ever get interest in this stock again, it would have to be a lot closer to $12.50 for us to even, become interested in the slightest. Now, currently it is around that $14.30 mark, so as you can see, that is far higher than where the actual price point I'm talking about.
Okay, fantastic. Let's move forward. Thanks very much for that, Nick. Another one, Ansell, again, another stock that has been in the Market Matters portfolio from time to time. Large portions of their earnings are exposed to North American stories, exposed to the Euro and the Brexit story. It looks like it's had a bit of a fall from grace from mid-2015. Are you guys looking at it? What's the view there?
Okay, so we've been an Ansell in the past, Edward, and we are we were a buyer around that $15 mark recently when it was oversold on bad news. Now, our current view, and we're happy to say this, is 50-50, so we're unsure. And it's all right to be unsure in markets. You've got to look for, risk reward, and you've got to look for everything to align if you're going to buy something. Now, we're 50-50 here. Also, as well, with Ansell, there is some risk around Brexit, but they do a lot of currency hedging, and as a result of that, we think the impact of a Brexit on something like Ansell might be quite minimal, but all the same, we are 50-50 here. There's no clear signals, and as a result, we think that's best left alone for the time being.
Okay, fantastic. Thanks, Nick. Okay, another one, Nick. CSL, it's had a tremendous run. It's been a great story, a bit of a market darling. Another one of those stocks that's got exposure to that Brexit story. How are you feeling about CSL?
Okay, CSL is a phenomenal company. We really like it, and we actually think that events like Brexit, give us opportunities to buy quality names like this at great prices. Now, we covered this in our morning report this morning, so some people would have heard our view on this at the time. Now, what we think, as I said before, it's a great company. We'd love to buy it into weakness. It has already pulled back about 6 to 7%. We would accumulate this stock or buy this stock under $105. And after that point in time, we would buy any further weakness in the stock moving forward. So investors out there listening, that is definitely one for the watch list. Most people probably own this. I speak to a lot of people on the phone that own it from $30 or $40 in years gone by. So congratulations to them.
Wonderful. So potentially looking at CSL as a buy and averaging down under 105. Fantastic. Thanks, Nick. Okay, moving forward. We've been talking so much about what's been going on overseas in Europe, in the US with interest rates. I think we'd be remiss if we didn't touch on domestic interest rates here in Australia. How important are domestic interest rates, I guess, in terms of Market Matters' investment strategy? What are you focusing on, and where do you see them going?
Okay, so interest rates are currently at all-time lows at 1.75%. Now, what our view on interest rates here at the moment is we think that interest rates will most likely stay the same for now, but we think interest rates will be lower for longer, and we do think that interest rates will stay around this level for 12 to 24 months. And for that view to change, we'd have to see some positive data coming out of Australia. Now, you've got to look at where interest rates are globally as well, and bond yields from a lot of countries are in negative territory, and that's all because their cash rates are incredibly low. Almost, in a lot of instances, they're actually negative, meaning that you've got to pay the bank to put money in it, which is quite a bizarre scenario. So I guess the best lead we are getting for where interest rates are going here in Australia is coming from where the currency is. Now, the meeting last night with the Fed, we think will keep a lid on our currency for now. We'll keep a lid on the currency for now, which will mean that we think interest rates can sort of stay around current levels. A lot of people are calling at least one more cut. If we saw something like that, we don't think that's a massive move. The more and more cuts, the impact is starting to get a little bit more minimal than it was.
Fantastic. So, Nick, I guess having a look at some of the information, the data out there, I mean, compared to the likes of the Brexit and compared to the likes of US interest rates and where they're heading moving forward, would you say that, keeping an eye on Australian interest rates is just as important? Would you say it's kind of secondary or a bit of a smokescreen? How are you interpreting that?
I think the most important thing is what's happening with rates in the US. What is happening here in Australia is secondary to that. As a result of that, I think all investors should be doing is knowing that rates will be probably lower here in Australia for longer. And as a result, as I said earlier, we still think that some of the stocks that pay good dividend yields will be supported, not all.
Okay, fantastic. So we know that there's a real mentality of moving out of term deposits and all the rest of it when interest rates get cut. And we do get a lot of questions on, I guess, how we're perceiving the banks and opportunities within that sector. So let's have a look at one of the more popular ones. I know it's a stock that Market Matters have in its portfolio, Westpac. What are you seeing there, Nick, and how are you playing it?
Okay, so we own Westpac. We bought this for a dividend, and we have received the dividend already. Now, what our current view on Westpac is having a bit of a tough time at the moment with the market. Being sold off. Investors are quite scared to see around what's happening with the Brexit. Now, our view on Westpac is we would happily accumulate Westpac into major weakness under $28. So it's not too far from where it is now. Bear in mind, Market Matters, our portfolio, we have 36% cash at the moment, and we wouldn't be scared about putting that cash to work in some of the current names we already own, as opposed to going out and finding new stocks altogether. So Westpac's definitely on our radar to buy some more, potentially under $28, and we'd happily accumulate weakness if we see more.
Fantastic. And another bank that's just been, I guess, it's treated Market Matters very, very well, and probably the most popular of the big four, Commonwealth Bank, CBA. Again, with another interest rate cut here in Australia looming, is it worth considering Commonwealth Bank?
Okay, so we own Commonwealth Bank. We last sold it at $95 and started accumulating it in the high 70s. Now, Commonwealth Bank at the moment is currently in the sort of mid to low 70s. It's currently the actual price is around that sort of $72 mark at the moment. Now, it's our preferred bank. We think it's the safest of all the banks. Bear in mind, though, it has pulled back over $20. In 2010 and 2011, it pulled back $18. And the pullbacks in CBA, we think, is something that should be bought. And at the moment, we think that you could accumulate weakness in CBA of around $70 or under $70. Obviously, as we said before, it's the most well-run bank. In terms of a dividend yield, you're probably looking at over 5%. At current levels, it's probably over 5%, 5.5%. Towards 6%, and that is fully franked. Obviously, we've got the franking regulations here in Australia, which benefit investors as well.
Fantastic. Okay, excellent. With all this movement in interest rates and potential with currencies, one talking point that tends to pop up time and time again is commodities. Market Matters has had a fair bit of success in picking this particular area. Nick, what approach is Market Matters taking with commodities, and how are you viewing that space in general?
Okay, so commodities is a very interesting one. We wrote an outlook piece to start the year, and at that point in time, we actually said that mining stocks could be held in the portfolio for the medium term for the first time in quite a while. And since the start of the year, we have held positions in stocks like Fortescue, in stocks like Rio, in stocks like BHP. Now, our current view on commodities at the moment comes down to more the individual commodities themselves, as opposed to throwing a blanket over the whole entire space, which we kind of did at the start of the year with weakness in the US dollar, which is now reversed.
Okay, Nick, so on that note, let's have a look at some of the more prominent and popular commodities, one at a time. What are you seeing on the copper front here? We know historically copper has been an indicator of how an economy is performing. We've seen a fairly big pullback from copper over the last few years. Is Market Matters considering increasing their copper exposure?
No, we're not, Ed. Copper's in a bear market. We've called this bear market for a couple of years now. We still think it's in a bear market. We don't think that's going to change. You'd have to look as far forward as 2017 or late 2017 for any change in that view. And into 2017 it becomes a bit of a supply and demand story. But as I said before, we're bearish on copper still.
Okay, fantastic. Next up, we have crude oil. That crude oil price has had a bit of a bounce to kick off the year. Market Matters has been in and out of a few different stocks. How are you seeing that oil story in general?
Okay. So to start the year, crude and iron ore were almost rallying in tandem. Now, they've decoupled. We've touched on this a lot in the reports. Now, to cover crude oil, what we anticipate is, if you look at the low, it got as low as $26, and it did get over $50 recently, currently around the $47 mark. You've got to think of how large this move up is. We're talking about 100% or almost 100% move in the actual underlying price. Now, in years gone by, for that to happen, that would have happened not over a few months. It would have happened over a few years. Also, we'd need a war or something like that to drive such a move in that price. So our short to medium term view on oil is the following. We think that we wouldn't be surprised if the consolidator came back a couple of dollars and found a home around that sort of $45 mark. But we do anticipate higher prices in oil, over $50 over the medium term. Now, one thing as well, it was a supply story towards the end of 2015 and into 2015. That oversupply has started to even out, and we've seen a lot of the shale oil producers in the US go out of business. Now, this means less supply, which is obviously having an upward impact on the actual oil price, which is positive and has led to some of our stock positions over the last few months.
Well, let's have a look at one of those stock positions, Nick. Origin Energy. Market Matters has taken a position in this particular stock recently. It's at around 528 at the moment. How are you feeling about it today, and where do you see it moving forward?
Well, I must say one thing, Ed. Markets can be really cruel sometimes. It was only a week or so ago that we were looking at taking a bit of a profit in Origin around that $6, $6.20 was our price target. It got close. It did get very close. Now, we had bought this in the mid to low fives. Now we're sitting with the stock back at, around that $5.28 mark. Now, this was our way in playing the recent move in the oil price over 50, which we did see. But the stock has obviously experienced a bit of short-term weakness with what's happening with the Brexit, amongst a few other things. Now, we still think that Origin is a buy, and we would be happy to accumulate weakness in Origin in the low fives. Bear in mind, we have 35 or 36% cash, as I indicated before. So we're a buyer of this stock. We do think sometime over the next 12 months, Origin will rally $1 and get over $6. So based on that view, we're happy to accumulate that in the low fives, knowing that we do have a price target over 6. As I said, current price target, though, where we'd start taking some initial profits, will be $6.20.
Wow, okay, price target there of $6.20. Thanks very much for that, Nick. Now, moving forward, obviously during these fearful times, we can't go past gold and having a look at the gold price. It's acted as a bit of a safe haven historically. It's had a really, really tremendous run to kick off the year. Is that run going to continue? How are Market Matters playing it? And, what's the general feel over here?
Okay, so we like gold long-term. It's broken out of its long-term bear market, and we do like it long-term. But currently, we don't have any positions in the gold space. Now, we did call at the start of the year, I keep on referring back to this outlook piece, but one thing we really have to emphasize is people need a plan. You need to follow a plan. You can't just, fly too close to the sun. So what we anticipate with gold is short-term, we're seeing a bit of a double top here, and there's some key overhead resistance around that $1,300 mark. We think that gold will go higher, but short-term, we would not be surprised if we saw something like a $50 to $100 drop in the gold price if something like the Brexit doesn't transpire. You're seeing a reasonable bout of hot money going into the gold space at the moment. So the reason being is people are chasing something that's safe haven with all this risk events going on in the market. As a result of all this, this is something that we don't like to speculate on and play within the portfolio. We did, although let me take the back step here. We did have a successful investment in Regis that we had recently, and we are looking before, a good opportunity to get that again. And if we see the Brexit not get up, that could be the catalyst for gold to show a bit of weakness and provide some opportunity.
Okay, now you mentioned a double top there. Assuming that it doesn't break through, you have a pullback. You do get that 50 to 100% pullback. Will you be looking to buy Regis again? You've had a lot of success with it in the past.
Yeah, I have to say that Regis has been one of our favourites. We've done very well with Regis over the last couple of years, and I know that a lot of our subscribers would obviously justify that. Now, recently we managed to buy Regis at around about the $2.83 mark, and we saw a massive move up in gold when we saw that bad data print, which allowed us to get out of Regis around the sort of $3.20 mark. Now,
Nick, sorry to jump in, Nick, but I've noticed that Market Matters is, I guess, constantly, when there's an opportunity in the gold space, constantly looking to Regis as one of your dependable gold stocks. Is there a reason behind that constant reliance on Regis or confidence in the stock?
Okay, so if we're going to play a theme, we don't really go for the penny dreadfuls. We like the sort of larger to mid-cap stocks. They offer good risk reward. Now, the reason why we have the love affair with Regis is, they've got a 6 to 7 year mine life. They actually are paying a dividend. They actually had an announcement the other day where they cleared all their debt, so they're debt-free. So what we like to say is there's no skeletons in the closet. And as a result, we're happy to buy it. One other thing I want to also touch on as well is they produce a lot of their gold in Aussie dollar terms. So if we do see the US dollar strengthen and the spot price of gold actually weaken, some of this move in the gold price is actually negated from the move in the currency. So something like Regis, we prefer to trade it though. Being in that commodity space and being a price taker, we don't like sort of holding it for the long term.
Now we see here, Nick, if we have a look at this Regis chart, we've got 220, which I guess up around that 220 mark at the end of 2014, early 2015. And we've seen it again to kick off the year, a bit of a double bottom formation there. Is that the target that you're looking for, Nick? What are you expecting, I guess? Where is that opportunity, just so we make it clear to our viewers?
We think there could be an opportunity short term if the gold price does tank around the Brexit vote. If the Brexit vote doesn't get up, which is more than likely, which is our view, we could see some weakness in the gold price. There's been a lot of hot money going into it. That may provide an opportunity. You've got to remember these stocks are very volatile. So that might provide an opportunity for us to buy Regis. And we'd like to start, it may be something that we accumulate as opposed to, buy a full position. Now, we would be looking at probably back below the $3 mark.
Fantastic. Okay, so Nick, next slide is iron ore. Very interesting. A lot of investors have had their fingers burnt with iron ore. There's been a handful of investors that have done well. Market Matters avoided iron ore in 2015, which is part of the reason for your outperformance. And interestingly enough, you seem to go back into iron ore head first earlier this year, and now you don't seem to have any exposure. What's the general sentiment towards iron ore from Market Matters?
We just think with iron ore, there's just too much supply coming onto the market. You've got Gina Rinehart, Roy Hill, amongst other things. So there's just too much, supply coming on, which is going to have a negative impact on the price. Now, the move up at the start of the year was twofold. It was to do with all commodities rallying, but it was also to do with a lot of speculation around Chinese investors speculating on the iron ore price. What our view is at the moment is not incredibly clear. Thus, we have no positions in this space. But we do think iron ore will make new lows below $35. At that point in time, we may get interested in buying one of the larger cap iron ore producers into a bit of a swing low.
Okay, fantastic. So if we do see that swing low, what buying opportunities will we be looking for? We've got Fortescue here. Nick, it's been a bit of a Market Matters darling. I know you were in and out of the stock on several occasions this year, doing extremely well despite the tough climate. Is there another opportunity here for investors, and why?
Okay, so Fortescue is one that, you're right, Ed. We have traded this, very well in the past. We've made a fair bit of money out of Fortescue, which is always good. Now, at the moment, it's very choppy, we must say, and it's not really giving us any clear signals. As I stated before, we do have a $35 price target on iron ore, which is far lower than where it is now. So as a result, we don't like iron ore stocks at the moment, and we're not looking to buy any short term. However, one thing that we have to say about Fortescue is fundamentally it's really lifted its game. and it's really turned a lot of things around. And as a result of all this, obviously a lot of stuff around its debt and its operations. As a result of all this, we would be keen buyers at around the sort of $2.50 mark. And it was as low as there around about April this year. So, it is one for the watch list, not buying it today, but we do things quick here, and when things happen, they happen quite quickly. So we've definitely got this on our watch list at this present point in time.
Fantastic, Nick. Thank you very much for that. So a few buying ideas there. Now, just heading into the fifth and final topic. Before we do that, just want to remind everybody that the information in this presentation is of a general nature only. It does not take into account the investment objectives, financial situations, or needs of any individual investor. Before making an investment decision, we recommend that you consult with your financial advisor. On that note, here are 3 stocks on Market Matters' buy radar coming up. I guess especially considering that, I guess it sounds to me like Market Matters is expecting volatility, regardless of whether or not a Brexit takes place. You are expecting some volatility. So let's have a look at the first stock, Henderson Group. Well, are you looking to buy this one, Nick? What's the general feel here?
Okay, so Henderson Group, HGG is the ticker on that. We are setting up to potentially buy this stock in the short term. Obviously, it would have to get to our price target first. Now, Henderson Group is a global fund manager, but its main exposure is over in the UK and Europe, and a high percentage of its earnings are coming from that Britain region, which as a result, the stock has been sold off on the back of this. Now, we like the management. We also think that the stock trades at a discount to other global fund managers, which, is something that we like in this space. We like things that are trading at a discount relative to its peers. Now, for us to buy this stock or get involved in this opportunity, we'd initially be looking below the $4.30 mark. Now, look, at the moment, it's about $4.65, but we'd be getting interested initially around that $4.30 mark, and we'd love to buy it around that $4 mark. If we got that opportunity, we would be licking our lips, and this would be something that we'd be looking at. We'd love to be able to get it before the vote. Given that our view is a stay, there'll be, the UK will stay in, Brexit will not get up. We would love to buy this before the day, and we'd love to get an opportunity, around that level that I just indicated there.
Interesting. It's only about 7 days away, if I'm not mistaken. The 23rd is the big date. So,
yeah, next Thursday.
Fantastic. Okay. Moving forward, another one. It's been a bit of a champion of the market over the years, Ramsay Health Care. We know that a large portion of their earnings is reported abroad. Up at about 71 at the moment, Nick. Is this one on your radar as well?
Yeah, we really like Ramsay, and we've always liked it, but we haven't held it very often over the years because it's one of those ones that's sort of always traded at a premium to where we like to buy stocks. And as a result of that, we haven't had too many flooders into it, although we do think it's a phenomenally very well-run company, and we really, as I said, do like it. But for us to get interested in this, it is something that's kind of linked to the Brexit. For us to be interested, we did cover this in the morning report this morning, though, as well. Firstly, I just want to touch on what Ramsay does. It's involved in hospitals, a lot of them over in France. Now, our price target on this stock, to buy the stock, would be around the $69 region. And if we were to buy Ramsay, we'd be running pretty tight stops or relatively tight stops below the $69 region at about the $67 mark. So RHC is the ticker on that, currently trading at about $71. Well worth putting on the watch list, investors out there, if you don't already own it. Anticipating an opportunity to buy that soon.
Fantastic. And I guess one more for the road, Nick. Everybody knows this one, QBE Insurance. Been bouncing around all over the place over the last, been range bound between 10 and 15 over the last 2 to 3 years, currently sitting at around 11.49. I don't recall Market Matters dabbling in this particular stock before. Is that about to change?
Well, Ed, one thing I must say about QBE is QBE has had the kitchen sink thrown at it. Literally has had the kitchen sink thrown at it recently. We've had the storms in Sydney in the last few weeks. We've had US rates go against them. And we've also had commercial insurance premiums contract, which is not good for their bottom line. Now, We liked stocks that have had a lot of bad news thrown at them and held up in a relatively resilient fashion. So QBE is on our radar at the moment. Now, the reason why we like it is we think these trends could easily reverse in the short to medium term. And we are looking to be able to potentially buy this stock. Now, it currently trades at $11.49. We would love to get it around that $11 mark, anticipating a bit of a bounce off that level. And also as well, we do think eventually rates are going to go up in the US, and QBE holds a lot of money in US Treasuries. So every 25 basis point hike in rates in the US is contributing directly to QBE's bottom line. I don't have the exact number, but it's contributing directly to QBE's bottom line. So those are the three that we're looking at the moment.